Hello ladies and gentlemen. Thank you for watching Life Care Insurance series on business owners. Today we are going to pick up another topic on corporate taxation strategies, and I have my friend Ray Banji with me. Hi Ray, welcome to Life Care Insurance special series on business owners.
Thank you for having me, Saurabh. It's a pleasure to being here.
Thank you. And you know what, as a business owner, we all work really hard for ourselves, for our employees, for our customers, and we have a goal to make everybody's life better. Now, saving taxes is everybody's goal, and I also agree to that. And saving taxes legitimately is also important and something which we can do for you. And today, under this planning or under this topic, we're going to show you how you can save up to 30% of the taxes. And believe me, it's not a magic, it's just a planning. And today we are here, me and Ray, to talk about the strategy and to show you how you can save a real tax as well as make a difference in your overall financial planning. Yes, Ray.
Hi, Saurabh. How are you?
I'm good. How are you?
I'm doing great.
Thank you. So, what are the risks associated with owning a business as far as a shareholder or owner of a business is concerned?
Yes. Well, oftentimes when we're business owners, there are three things to be really concerned about. But it comes down to the most important part, the ability to earn an income. And the three things that we should be thinking about are ultimately, number one, our health, number two, our wealth, and number three, the final and unforeseen event in the event of death.
Yep.
So what we want to do is we want to put a plan together that's going to cover all those three things to protect the most important asset, which is our ability to earn an income.
So the health of the individual, the key person, the shareholder, the director who is responsible for the business, what you mean to say is, if I have to sum up, that if I'm not in the business, if I'm not there, how the business will run, how the business will move on, and how I can protect myself as well as my business interest as well as the family interest by incorporating this planning.
Absolutely, and that's exactly what we're talking about here. So just as an example, the question that should be on everyone's minds when they own a business is, in the event of a heart attack, stroke, or cancer, what would happen to your business? Would your clients or your patients or your customers be ready to deal with another person if it's not you, if you're no longer there to run and operate the business? What would happen to your revenues? What would happen to your expenses? So oftentimes we talk a little bit about a plan called the Executive Health Plan, which actually does and accomplishes those three things that I just mentioned earlier.
Perfect. And most importantly, when we talk about small business, medium business, or micro business, even if he or she, the individual is a doctor, dentist, accountant, lawyer, or a franchise owner, or a manufacturer, you are the key person. You are the person who is making the things happen on the floor as well as inside your family as well. So protecting an individual means protecting the wealth of your family, protecting the business, and most importantly, if you're not there, if you are practicing as a dentist and you do not work in your practice, who will work for you? So basically under this plan, you protect your ability or your well-being, or I would say you protect your most important asset, which is your health.
Absolutely.
So how do you structure EHP, Executive Health Security Plan? So how do you structure it? What are the main components of the plan? How does the plan work, and what are the key ingredients to look at before you actually get into this kind of planning?
Absolutely. So in essence, there are three parties to the plan. There is the corporation, which we would like to see it to be incorporated. There is the actual owner, the shareholder, the president, the CEO of the company. And thirdly, there is the insurance company. Those are the three parties to the plan.
Okay.
Inside the contract, there are three provisions. The first provision is the critical illness provision. So in the event of a diagnosis of a critical illness, then that money would then flow back to the business so that the business would help fund the key person, help fund a continuing salary in the event of any issues that arise out of that. There is also a death benefit component, because God forbid if that were to exist, then there would be money continuing to the business to maybe wind up the business or make sure that there's any last loose ends to be taken care of. But the most important thing that we want to discuss is something called a health benefit. And what the health benefit allows people to do is it allows people to receive all those premiums premiums that we've put into the policy, it allows them to receive it out tax-free and flow to them in their pocket to help supplement their retirement.
Okay.
So the structure is a very simple structure. The company pays for the premium.
Okay.
Out of the corporate dollars, which, as you noted, which is a tax-saving strategy right there, having a corporate-owned insurance policy. The byproduct of it is that if there's no claim ever made, then the shareholder, which is the president and the CEO, they receive those monies tax-free to come into their pocket so that they can help supplement their retirement. And that's the structure, typically, of how it's usually set up.
Perfect. So basically you own a corporation. You have a corporation under which you have a small business deduction because it's a CCPC, Canadian Controlled Private Corporation, and you pay a lower tax rate on your corporate earning, which means if you buy an executive health plan or you subscribe to the plan, you basically protect your ability to earn in an event of critical illness like heart attack, cancer, stroke, or any specified illness. You get a lump sum benefit paid out to the corporation, and then corporation can utilize those funds in different, I would say, means, as Ray said. But the most important part is you save up to 30% taxes. Since you're not paying the premiums out of your own individual pocket, because if you're taking out a dividend of the corporation, you pay the general corporate tax rate at the first instance, and then you pay the dividend tax rate, and then you pay for the premiums or the planning aspect of the policy, which doesn't make sense. So instead of owning it as individual, you own it under the corporation.
Absolutely.
And you save on the premium, and since the corporation owns the policy, it is a perfect tool for you as well as for your corporation to protect the key person, which is you. So Ray, what are the other tax benefits associated with a corporate-owned executive health plan?
Okay. Well, the biggest one, of course, is that, God forbid, in the event of a diagnosis of a critical illness, that benefit flows to the company tax-free. The other benefit is that, well, if I don't get diagnosed with a critical illness, then that benefit flows to the shareholder or the president or the CEO of the company tax-free. And we're utilizing the provisions in the Income Tax Act that allows you to do that.
Wow. So that means, having said that corporation pays for the premium, you are the person who is protected, corporation owns the policy. If something happens, corporation gets the benefit. And if you are retired, you hit the age of retirement, or you have succeeded your business, you are no longer in the business, which means you are retired. I won't say retired, I would say that maybe the next generation has kicked in, or you have sold your business to another party. So you get all your premiums back tax-free?
That's absolutely correct.
Are you sure?
I am 100% positive, and that's something that's provided under the Section 146 of the Income Tax Act that allows all life insurance to be paid out tax-free in the event of death or critical illness.
So basically the premiums which you pay for the plan, they come from the retained earnings.
Correct.
So the general tax rate which you have paid on the corporate earnings, and the money which you haven't distributed as a dividend gets retained in the corporation, which is called retained earnings, and you pay your premiums out from those tax dollars.
Absolutely.
Low tax corporate dollars.
Absolutely. And the retained earnings is what we typically see is dentists, doctors, accountants, oftentimes businesses that are thriving, they have money sitting inside their retained earnings. And often the question is, well, how do I get that money out without paying taxes? Well, what this provision allows you to do is it allows you to utilize those retained earnings in a tax-efficient way. So in essence, we're paying money from the retained earnings, and the idea of it is, well, at the end of the day, when you don't get a critical illness, the byproduct is that the money's flowing from the retained earnings into your pocket so that you could help supplement that retirement income that you may want to need someday.
Very nice. So basically, to sum up, when you're young, you subscribe to a plan called EHP, Executive Health Security Plan. You protected your health, you protected your well-being, you protected your business. You use low tax corporate dollars to fund the policy. Now you hit the age of retirement, you no longer want to keep the policy, you cancel the policy, or you are no longer owning that contract, you get all your money back in your hand, which means you use the corporate dollar to fund the policy, but you received all the money in your hand to use anywhere. You can use on your lifestyle, you can use inside your investment, you can put that money, or you can give away that money to anybody. That means you save taxes upfront, you you protected yourself, as well as you utilized the funds if you didn't use it, which I would say that nobody should contract any illness or injury. But if you are absolutely fine, utilize your funds as your own wish, right?
Absolutely, absolutely. And there's one important statistic that came out from the Canadian Cancer information, and that is 1 in 2 Canadians will be diagnosed with cancer before the age of 65. So I just want you to imagine that statistic, and maybe some of us have family and friends that we know of. If that happened to you, what would happen to your family? What would happen to your income? What would happen to your business? At the end of the day, the most important thing that we want to protect is ourselves, our ability to earn an income. And by having an executive health plan, it's a win-win-win strategy here. We're saving money on taxes, we're protecting our family and our health, and more importantly, if nothing happens, we're also supplementing our retirement.
Yeah, and I think it's like with one stone you kill 2 birds.
Absolutely.
As well as I would say in the end that plans never fail, people fail to plan. So never let your plan fail. Keep your plan always up and running, and if you really need to protect yourself, your family, or you want to have that tax planning incorporated inside your business, come talk to us, and we are always there to help you. Thank you very much. Thank you, Ray.
Thank you very much.